Thank you. It's a pleasure to be here, and it's impressive that what a great turnout we have for this event. Not surprising, given the great panelists we have. So I'm going to introduce the panelists in alphabetical order. I think you have their short bios, but let me just do that quickly. So I'm going to go in alphabetical order. Gaston Gillos is the chief of the Global Financial Stability Analysis Division at the International Monetary Fund, where he is, among other things, in charge of the analytical chapters of the IMF's Global Financial Stability Report. He held a variety of previous positions at the IMF, and he's worked there since 1998. Our second speaker will be Peter Fisher. He is a senior fellow at the Center for Global Business and Government at the Tuck School of Business at Dartmouth. He's also a senior lecturer there. He serves as a senior director at BlackRock Investment Institute. He's on the board of directors of AIG, the Peterson Institute, our competitor across the street, and the John F. Kennedy Library Foundation. He has, as many of you know, served as the Undersecretary of the U.S. Treasury for Domestic Finance from 2001 to 2003, and held the position of Executive Vice President and Manager of the Federal Reserve Open Market Account. Our third speaker is Mary Miller. She served as the U.S. Department of the Treasury's Undersecretary for Domestic Finance from April 2012 to September 2014. In that position, she was responsible for developing and coordinating Treasury's policies and guidance in the areas of financial institutions. Prior to joining the Treasury, she also had a previous position at the Treasury, but prior to joining the Treasury, Mary spent 26 years working for T. Rowe Price, so she knows a little bit about asset management. And our fourth speaker is Matthew Richardson. He's the Charles E. Simon Professor of Applied Financial Economics at the Stern School of Business at New York University. He currently holds the position of Sidney Homer Director of the Solomon Center for the Study of Financial Institutions. He's got a very distinguished list of publications, as indeed have some of our other panelists. So what we're going to do is to go in order. Each speaker is going to speak for about 10 minutes. It's a little cumbersome going up and back, but we do that in case people want to do slides. And then we're going to sit up the front and have a discussion and get questions from the audience. So I'm going to start with Gaston, if you could come up first. F comes before G. You know, as you get older, these things happen, don't they? F comes before G. Peter.
Thank you very much. Great treat to be here. Thank you for having me. Let me try to jump right into my remarks. And thank Brian for his terrific presentation. I think Brian asked and answered the most important question, which is, what are the facts? Let me try to pose the second most important question, which I think that too often economists and policymakers jump over this second question, which was most eloquently posed in 1969 by Eddie Harris and Les McCann in their hit jazz single, Compared to What? To be precise, looks like we always end up in a rut, trying to make it real, compared to what? And I want to challenge myself and us all today to be clear when we're talking about asset management that we think about compared to what? When we're making statements, normative statements, we think about what's the thing we're contrasting it to. And I'm just going to make three quick points with my time. One is we have agency problems compared to what? Other agency problems. We're not living in a world where we have a choice between this set of agency problems and every investor a principal for their own account. That's not the world we're thinking of. And I think it's important when we start from first principles to think very clearly about that. Secondly, about the macroeconomic significance of asset managers, it's really important here to be clear on compared to what. You can think they're really significant, or I think you can think they're not very significant in macroeconomic terms. There might be very important microeconomic, competitive ramifications, structure of industry ramifications. And my third point is a liquidity illusion, again, compared to what? I teach my students liquidity illusion is always with us. It's a feature of finance capitalism. It's not about any one sector of our financial system. So first, asset managers compared to what? The more I thought about this as we prepared for the panel, and I think Brian's talk brought it out, when we are talking about asset managers, we think we're jumping in, even if we're not very clear about it, to agents of limited discretion plus pooled vehicles. And that's actually a subset of the asset management industry, as Brian explained. I don't want to dwell on that, but I think that's actually the thing we're comparing it to, where we're thinking about it. But everything else is agents too. In fact, our legal structure in the United States requires people to trade stocks and bonds through registered agents. I can't just go sell my own stocks and bonds if I wanted to. I've got to go use a broker-dealer if I want to execute a trade. And so I think it's really important we think clearly about agency problems. They're ubiquitous. They're always with us. I spoke on a panel like this, and Jack Bogle was with me, and I made this comment that agency problems are ubiquitous in the financial services industry. And Jack said, "Congratulations, it took you 25 years to figure that out." And so I think it's really important we think clearly about that. A point of sort of departure for me. I spent a decade being the public sector's asset manager, as Martin said, as the manager of the System Open Market Account. And I spent about a decade at BlackRock helping manage assets there. When I was the Fed's manager of the System Open Market Account, I had a written delegation of authority from the Open Market Committee to manage assets. That could have been a contract, an asset management contract, and I could have been outsourced and had my own little balance sheet. Now, for privacy concerns, I think the Open Market Committee would probably not have liked that. They would rather have it an in-house asset manager. But who would have thought you would have cared about? Imagine that I was this independent asset management company just managing the FOMC's assets. Imagine anyone caring about my balance sheet rather than the balance sheet of the 12 reserve banks whose assets I was managing. Now, I sat here at a podium a few months ago in the room across the way, and a former vice chairman of the Fed said, well, BlackRock could buy a whole lot of bonds. And it was a little embarrassing moment where I had to point out that actually, as Brian did, the delegation is quite limited. You can't just swing all the money from equities to bonds. It all comes in the flavors, just as the FOMC has prescribed the delegation to the manager of the System Open Market Account. So I think the first point, compared to what asset managers are a subset of agents, and the agents are ubiquitous, and we all are managing assets different ways. And I think that's why it's so important what the FSOC did to switch over and focus on activities and behaviors rather than legal entities. I think that was a really important step forward so that we start to think clearly about this. Secondly, the macroeconomic significance of asset managers compared to what? Now, compared to a world in which we don't have the pool of savings they're managing, yes, that macroeconomic world would be very different. But that's not really the world we get to compare to. We have a daisy chain of delegations going on, and these create those agency problems. But the macroeconomic significance in terms of credit origination, I'm skeptical about, again, compared to what? 50 years ago, if an issuer of securities, whether debt or equity in the United States, wanted to figure out what they should be issuing, they would have called up a very small group of entities called broker-dealers that were rather trivial in size. But they probably also would have placed a few calls to big insurance company CIOs. And they would have listened to everybody, and then they would have decided where they're going to issue, and then those broker-dealers would have underwritten those bonds. Today, there have been some changes in the microeconomic structure of the industry, and those same issuers will call up the insurance company and pension fund CIOs, they'll call up the broker-dealers, and they'll call up some of the big asset managers, and they'll get opinions about it. And then they'll decide what they're going to issue, stocks, bonds, the 10-year point, preferred shares. It's going to be driven by their capital structure. So the asset manager has an influence over what is issued, what credit is originated in this economy. But it's just as one of a series of agents that are consulted by the issuers, who are going to decide for their own purposes. And the asset manager is, again, it's the sum of all those investment management guidelines the asset manager has. Now, but clearly, there are competitive issues that are changing in the industry inside that. But I don't think those are macroeconomic issues. The macroeconomic issue is we have a lot of credit that gets originated in this economy, and some of it seems to be going straight to asset managers now, but again, it's going to those balance sheets that stand behind the asset managers. And I've been worried since the financial crisis when people look to the asset management industry as a source of credit. Boy, is that a problem. Because we don't have, the asset management industry doesn't have the same leverage and the same discretion that a bank balance sheet has. If we're looking to asset managers to fill the credit hole in America, that's a big problem because there isn't the same flexibility that the bank credit originator has, or bank underwriter of credit, where they really have much more latitude of what they park on the asset side of their balance sheet than the asset manager has. Much less leverage, much less discretion. Now, my third point I want to dwell on, well, I'm going to run out of time, aren't I? But liquidity illusion is always with us. It is ubiquitous. It is pervasive in our system. We cannot all take our money out of the bank today. We cannot all sell our stocks today. We cannot all sell our bonds today. Modern finance capitalism relies on a certain presumed velocity. And that's true every day. We notice it in 2008. But every day there's this pervasive liquidity illusion, and it's what the system works on. It's why, frankly, I think capitalism, finance capitalism, has given us a lot of advantages over our predecessors 500 years ago. And we have to accept the social consequence of that and then figure out how to manage it. And whether pooled vehicles create more or less, I think is an important debate for us to be having. And I ask my students at Dartmouth, how much cash should a 40 Act mutual fund hold, given the fiduciary duty both to those investors who want to stay in the fund for the long term and those who want to cash out tomorrow. And what I love about the question is there's no right answer, and it's really hard to come up with a definitive answer to that question. Now, I think what that involves is us working harder than we have at the question of gating pooled vehicles. And we've all been on all sides of this issue. Some of us think gating is a good thing. Some of us think gating is a bad thing. I think we've got to parse it out through the role of expectations. And be really clear that gating, excuse me, is or isn't a problem if it's fighting expectations in some way. The expectations of the underlying investors. And again, it's compared to what is gating a problem. It's to expectations. So thank you for the chance to chat. I'm trying to be provocative, as I usually do. And I'm going to end by repeating my challenge for the rest of the speakers today, compared to what. Thank you very much.
Thank you for the opportunity to be here. And I think what I'm going to say is very much complementing the previous interventions. I would like to focus on how to think about systemic risk related to what you may call the plain vanilla segments of the asset management industry. Risks from some part of the industry, for example, hedge funds and money market funds, are by now well recognized, and reforms are already underway in many jurisdictions. Hedge funds can incur substantial leverage and engage in complex and risky strategies. Many money market mutual funds, on the other hand, are not leveraged, but some of them have been offering redemptions at a constant dollar per share. This makes their liabilities deposit-like and vulnerable to runs, as shown during the crisis. The systemic risks related to these issues and to leverage are generally well understood, and to some extent they're being addressed. However, as was said before, the majority of products offered by the asset management industry does not suffer from the same vulnerabilities. Most investment vehicles, such as typical mutual funds, incur little balance sheet leverage and invest in publicly traded bonds and equities. They issue equity shares, and fund shareholders bear all the returns and losses from the investment. Therefore, solvency is usually not a concern. Moreover, the promise of redeeming at par does not exist outside of MMFs. Other sources of risks, however, are still potentially relevant in this segment. And here, any systemic effects are likely to occur through a disruptive impact on some asset prices and knock-on effects rather than through the solvency of an asset manager. And in thinking about this risk, I agree it's important to ask the compared to what question. It's important to distinguish conceptually between the type of risks that result from the presence of intermediaries and those that are merely a reflection of the behavior of ultimate investors as they would occur in the absence of these intermediaries. A point that was made by Doug Elliott in his piece on asset management very nicely, I thought. First, so let me highlight two main issues in this context. First, the delegation of investment decisions introduces incentive problems between end investors and fund managers, as was mentioned before, which can in principle yield destabilizing behavior and amplify shocks. Investors cannot directly observe managers' abilities and their effort, and therefore provide incentives to the manager to act in their interest. A common way of doing this is to evaluate funds relative to peers and compared to benchmarks. This, in turn, in principle, can lead to a variety of dynamics with potentially systemic implications. For example, the relative evaluation of fund managers can induce herding, which can destabilize prices and lead to the buildup of bubbles and subsequent busts. Such effects on asset prices can have broader macro-financial consequences through balance sheet and collateral channels, among others. In emerging markets, for example, there's evidence that benchmark-related incentives can explain some of the patterns of contagion across countries that we have seen around crisis. We also have evidence for herding both for the US and for emerging markets, although granted the reported magnitudes and effects on prices differ across studies. Second, the presence of easy redemption options can create run risk and augment the likelihood of fire sales. If redemptions are easy and assets held by the fund are not all very liquid, a first mover advantage for investors may exist even in the absence of guaranteed returns or the promise to redeem at par. This is the case if funds can be presumed to first sell the more liquid assets in response to large redemptions. Then if I, as an investor, see others withdrawing, I don't want to be the last in the queue. Alternatively, if the costs of redemptions are partly borne by remaining investors, as is often the case in the US but not necessarily elsewhere due to different pricing mechanisms, this accentuates incentives to withdraw early. Depending on market conditions and the structure of the market, large-scale redemption could, through fire sales, potentially have contagion effects to the rest of the financial system. Again, there is some evidence for this sort of run risk, both for advanced economies and for emerging markets. However, we still need to understand better the empirical importance of the different channels I just mentioned. One complication that empirical research faces, though, is that the type of dynamics one would really worry about have so far not or only partially occurred in mature economies. We therefore need to make inferences from the behavior of investors and fund managers during relatively quiet times or during the few episodes of large volatility. An additional complication stems from significant structural changes in financial markets, which limits the degree to which we can rely on older studies. I would argue, however, that we can also draw on the experience of emerging markets, where some of these issues have been explored in response to recurrent crisis and volatility. For example, we have seen that the impact of a portfolio relocation that is relatively minor from the point of view of one large fund or a group of funds can have profound and disruptive effects on a small market. This is the big elephant in the small pond effect. Why are we now in the context of advanced economies, why is there more reason to worry about these things, about these conceptual issues than in the past? Well, I think there are at least three reasons. Three structural reasons at least, and there may be more. One, the asset management industry has grown substantially. Second, banks have retrenched from many market-making activities, contributing to a reduction in liquidity. And third, the role of fixed income funds has expanded considerably. And price disruptions in fixed income markets have potentially much larger consequences than price movements in equity markets. More specifically, as pointed out in our October Global Financial Stability Report, in recent years, liquidity risks have risen in some fund segments in the US and in Europe. In both regions, fixed income funds tend to be exposed to liquidity and maturity risk much more than some years ago. Many credit funds hold illiquid credit instruments that trade infrequently in thin markets. The problem is that these fund inflows have created an illusion of liquidity in fixed income markets. The liquidity promised to investors in good times is likely to exceed the available liquidity provided by markets in times of stress. We do not know exactly how a disruption would look like if markets really got nervous. We do, however, know that some of the structural market liquidity measures have deteriorated. This is reflected in lower trading volumes, smaller trading sizes, smaller share of large trade, and less frequent trading of many securities. This deterioration in underlying structural liquidity may only become apparent when inflow liquidity disappears in times of stress. As mentioned earlier, I believe that we need to do further research to get a more updated assessment in order to understand better the actual importance of these risks. And this is not an easy task, and we're currently working on this for our April Global Financial Stability Report, where we hope to make a meaningful analytical contribution to the debate. Thank you.
Good morning, and thank you for the opportunity to be here with you today. As someone who spent over 25 years in the asset management industry, the past 5 years provided a very unique opportunity to look at this industry through the eyes of regulators. And as you know, and as Brian showed us, the asset management industry looms quite large in the financial landscape today, with enormous scale and specialization. This is not the industry that launched the Investment Company Act and the Investment Advisors Act of 1940. To be clear, I want to say up front that I see many benefits from professional asset management, and those include the risk management benefits of diversification as well as independent research, the economies of scale that reduce costs and improve pricing, especially for small investors, and the counter-cyclical benefits of rebalancing and asset allocation work in products like target date retirement funds, for example. Historically, the regulatory focus has largely been on investor protections and orderly markets. The financial crisis and the ensuing recession that we all experienced introduced a new concern: financial stability. From a broad perspective, I believe the U.S. capital markets offer many features that fuel growth and disperse risk. Investment products that link borrowers and investors should contribute to financial stability. But as we have learned, there are risks. Long-term capital management, the 2008 money market fund guarantee, and the flash crash of 2010 all implicated asset managers to some degree. While we can catalog many failures of asset management firms that occurred without any systemic harm, let me make a few points about today's landscape. First, we have a surprisingly uneven regulatory framework. We know a lot about mutual funds and exchange-traded funds, and a lot less about separate accounts and private funds. The excellent presentation that Brian gave us today largely focused on the public funds. I would like to see the same level of understanding about private funds. The Dodd-Frank legislation required reporting for hedge funds and private equity funds and trade reporting to new trade repositories. These are very good steps, but they're still in their infancy and nowhere near full transparency. Some specific risks that I see include the redemption provisions we've talked about that can promise instant liquidity on today less liquid pools of assets. I think it's time to take another look at that and refresh whether this broad spectrum of products can all meet the same test of liquidity. I think there are information lags. There's not enough real-time information on degrees of leverage, exposures, and liquidity, particularly in this private fund world. I understand that managers, for proprietary reasons, do not want to share their real-time exposures and positions in markets. But I also understand that it's important for regulators in the financial system to know if there is a buildup of exposure that should be understood. There are disincentives to hold cash when measured against fully invested market benchmarks. And this was a point I think Peter was making. How much cash should a mutual fund hold? It's hard to do that if your benchmark is a benchmark that doesn't have any cash in it. I see pricing and valuation gaps during periods of market stress, and we don't have good protocols for how to handle that. I think that's another area that would welcome some attention. And finally, some operational reliance on shared services by many managers that we should understand. After looking at this from numerous perspectives, I came to the view that it is the collective practices and activities of asset managers that need a review for systemic risk. Risks that cross many firms are not solved by the heightened supervision of a single firm. In fact, that could create some perverse incentives, perhaps conveying a seal of approval, or the opposite, driving investors away. I applaud the work that the FSOC has done and their recent request for comments in the Federal Register on this topic. I think they are asking the right questions, and I hope everyone in this room will consider commenting and adding to that discussion. Likewise, the SEC's recent public statements on work to improve the data collected and analyzed from asset managers, as well as heightened fund-level controls and transition plans, are very important areas to focus on. As we talk about these things today, I would pose some additional questions that we need to think about. How do we distinguish between asset managers that may be suffering temporary liquidity impairment versus credit or solvency issues? Should there be a lender of last resort plan for solvent but illiquid asset managers? Would that contribute to financial stability, or would it create the wrong incentives in the financial system? I don't have the answers, but I would rather have that debate now than wait for a financial crisis. I think this is a great forum here today, and I think there's a real opportunity to get ahead of the curve, to not wait for the next financial accident to legislate and regulate after the fact. These are not insurmountable problems, and I think a healthy dialogue and a healthy bit of work on this will solve many of these issues. We learned in the financial crisis that we had an outdated financial regulatory system. We've made a lot of progress, but there's more scope here to be proactive. Thank you very much.
I'd first like to thank Doug and the Brookings Institution. If I have a pained look on my face, it's not because of the topic of asset management. I had an altercation with a ski mountain in Utah last week, and it didn't turn out too good. Anyway, so my remarks today, they're going to be based a little bit on a consulting report that I did for a large mutual fund. So I'm going to kind of the topic I'm going to pick is a little narrow. I'm going to think about whether mutual funds should be designated as systemically important financial institutions as SIFIs. But I think the points I'm going to make kind of hold more broadly for the kind of asset management industry. And the arguments that I'm going to make are very much related to work that I've done at NYU with colleagues and are motivated by our kind of theoretical and empirical work that measures systemic risk as a firm's contribution to the aggregate capital shortfall of the financial system. So I'm always going to be going back to that in discussing the issue. And I want to, like Peter, I want to make three points. I think the first point is one that's not made enough, but I think it's important. And that is, at any given point in time, there is a positive supply of the risk of real assets in the economy. You know, real businesses, plant property equipment, labor markets, etc. And there are financial claims written on those assets, loans, bonds, equity, maybe they're broken down to asset-backed securities, maybe they're tranched out. Someone has to, or some entity has to hold those financial claims. My 11-year-old son in New York private school just recently learned about the law of conservation of mass. So, you know, you can move matter around, you can change it, you can separate mixtures, you can decompose substances, etc. But at the end, the mass remains constant. It's the same for risk. You can slice it, dice it, move it around through hedging, tranche it, do risk transfer. But at the end of the day, the same amount of real asset risk is out there. You can't change that, at least not at a given point in time. So from an economic welfare point of view, if you wanted to focus on minimizing systemic risk, and again, in my world, that's minimizing the expected aggregate capital shortfall in a crisis, who are the natural holders of those claims, or those financial claims? Is it highly levered financial firms with government backstops? You know, if you think of Dodd-Frank and the Volcker rule, isn't that what it's about? It's about sort of trying to get some of the risk at those institutions out to the unlevered part of the financial system. So from that perspective, I kind of view asset management more as a solution than as a problem. And that gets back to Pete's comment about in comparison to what. Secondly, and the second point, and this is kind of somewhat already been made by Brian, but if you compare banks and non-banks like insurance companies to the mutual fund industry, obviously they're very different. Mutual funds are a collective investment vehicle. They pull money from investors, act on their behalf by investing in a bunch of different securities. The asset management business may be risky because it depends on the quantity and risk of the assets under management, but the managers themselves don't bear the investment risk. The gains and losses are passed through to fund shareholders. So it's an important point to think of what's the difference between me holding Vanguard S&P 500 index fund or an ETF on the S&P 500 or the underlying securities or whatever. Economically, they're quite similar. Secondly, it's also been pointed out that mutual funds tend to have little leverage. So from our perspective, in terms of this kind of aggregate capital shortfall, mutual funds don't contribute directly to that capital shortfall. If they're going to contribute, it's going to come indirectly, which I'll discuss in a second. Third is when a mutual fund, they close down all the time. It's financial disintermediation doesn't result like you get with a bank. The assets are just transferred to another fund, and we kind of move on our way. So it really begs the question, if a mutual fund manager invests in an emerging market bond, how does that change systemic risk relative to the situation in which another investor invests in that same bond? Maybe myself invest in that bond. So I think that's something to kind of think about when we're thinking of systemic risk. Now, the third point, the final point, there is the theoretically plausible possibility of how systemic risk can get transmitted from mutual funds to the financial system, I think is potentially fire sales through excess redemptions. But I think there's 2 points we need to make there. The first is that's an indirect, and I'll get to that in a second, that's an indirect mechanism, not a direct one. And then the second point is, if that's the argument, then there's a number of hurdles, some significant, to actually, justify fire sales as that source. So I want to go through those hurdles. The first, and this has already been pointed out, is that you need to show that the structure of mutual funds somehow lead to redemptions in excess to what investors would do on their own account. So as I see it, this only occurs if you think the mutual fund is going to give you a better price than you could have on your own. If I sell the fund and invest in emerging markets, I get a better price than if I sold the ETF based on emerging market bonds, or if I sold the bonds on my own account. So that's, do you get a better price? And if that's the case, then it's a question of the pricing mechanism that mutual funds use. Clearly in the past there have been issues. A decade ago, I did research on market timing of mutual funds. That was an example where assets were mispriced at the NAV level. And one could argue the money market funds has already been brought up because of the stable NAV is another issue. So I think that's the first hurdle. You have to actually show that you get different prices that will encourage you to redeem more likely mutual funds than some other example. But even if you get excess redemptions, the stylized fact in the literature really is that the performance and fund flows, what drives fund flows is performance, and especially relative performance. And this also came up, and I think Brian showed a picture of sort of the cross-sectional variation during the crisis of fund flows. If I underperform, I lose flows. But if the person that's outperforming gains those flows. So it's a wash. It's not clear that that's going to lead to fire sales when you have that going on. So I think the redemption argument can only go through absolute performance. And then you have to make the argument that those redemptions are large enough on an absolute level to lead to fire sales, and then those fire sales are large enough to generate aggregate capital shortfalls elsewhere at levered financial institutions, elsewhere in the financial system. So that's a lot of ifs to get there. Let's suppose you get that. Let's suppose you have the excess redemptions. Let's suppose they lead to fire sales, and let's suppose those fire sales are significant enough to impact the balance sheets of the levered firms that we worry about. Even if this is the case, it's not clear why those redemptions are more severe for a large mutual fund than for a collection of smaller funds. Imagine the following thought experiment. You could take a large mutual fund, or you could take a portfolio of smaller mutual funds. You have the same number of assets in both. Why is it that the large funds have much higher redemptions? If they don't, then why is the regulatory focus on fund size, which it is in all these documents that you read, why is it on fund size and why isn't it on the sort of the redemption policy in general? Now, finally, even if you get the excess redemptions, even if you have the fire sales, even if you believe you can show empirically that it's actually large mutual funds that are the main contributor to this, so the increased likelihood of aggregate capital shortfalls come through the redemption policies of large mutual funds. There's a bit of a philosophical question here, and this gets back to the direct versus indirect concept of systemic risk. Is a systemic problem with the large mutual fund or with the levered financial institutions that are suffering these shortfalls? So in other words, if the levered financial institution were less levered or less exposed to emerging market debt or those risks, then systemic risk wouldn't have emerged in the first place. So I think there's an argument, who knows which way it goes, which path to systemic regulation is best. Is it to focus on the mutual funds or focus on the levered institutions or some combination of the two? So I'll leave those questions, and I guess we'll be at the panel. Yeah. Thank you.
Thank you. Our alphabet, and we have to know what order to sit in. This is a very demanding panel. So when you speak, press the button that says speak. And when you stop speaking, unpress it or press the mute button so that we don't have everybody's mics on at once. I'm not sure whether people are hearing at the back. Are the mics? They're not. Okay. Can we check whether these mics are? Hello, hello? I need to get closer? Closer, closer. Thank you. This panel, which has been really, I think, terrific, and the overall title on this panel is Stability and Growth. I think a lot of the discussion, maybe most or all of the discussion, was around stability, so I want to start a little bit talking about growth. So what are we looking for in an asset management industry, or in terms of its role as an intermediary in promoting economic growth? Well, I think first of all, is money being allocated in the right way? And I think all the panelists sort of said, well, that's not up to the asset management industry, it's up to the individual investors. But I'd like to raise a question with them about that, since asset managers usually give a lot of advice to their clients about what to invest in or how to allocate their portfolios. So let me raise that question. Do we think that, what's the role of asset managers in actually allocating capital and the influence that they may have on their clients? And then the second part of that is on the structure of, there's obviously a lot of debate about whether you should have actively managed funds or passively managed funds. And certainly I think the economics view on this is that passively managed funds, like the sort of vanguards of this world, are the way to go, because people can't overcome the sort of random walk aspects of financial markets. But it's equally true that there are asset managers who have been able to beat average returns. Some of the endowments, some of the academic endowments, certain classes of assets. So the second question then is the asset management industry efficient in terms of the way it operates? Keeping in mind, and again, a lot of people said, well, this is up to our clients. But a lot of clients actually aren't very sophisticated in what they may be very sophisticated in what they do in their jobs, and maybe they work in specific things, but often they may not know what the right strategies are. So let me just throw it out and get some responses. Do we think that this industry is serving the role of promoting growth by what it does in allocation of capital, or if it does anything on that? And is it offering an efficient channel of intermediation? Let me start with you.
That's a challenge. Okay. Let me start. Sure, make three comments in response to that. First, I think Matt posed a really important question that gets us into that, which is who's the optimal holder of the risk? So the efficiency that I think you should be going for is, are the assets getting in the hands of the right holders? And I think it's important to be clear, as several of us have tried, that the asset manager isn't a single liability. The asset manager is managing to hundreds of different liabilities of the different clients. And to turn the question around, I am aware of a regulatory effort on the part of those that care about these things to make clear they don't want to see any arbitrage in who's holding these assets between banks and non-banks. And I think that's exactly wrong. That is, the idea we're going to move to a world of capital rules that says insurance companies and pension funds and banks all should have the same capital rule, so they all have to hold the same assets, will mean we don't get to optimal risk takers. We won't get the assets in the hands of those who most efficiently are going to hold those assets. So I think the efficiency question for the economy is, do the assets end up in the hands of those who can take that slice of risk most efficiently? And the asset manager is the switching station in that. You have some clients who have very long-durated investment horizons, and others that have very short, and some that have very high volatility willingness to take, and others very low, and you're trying to allocate among them. And so whether they're sophisticated or not, they tend to be pretty prescriptive. I mean, a not very sophisticated state pension fund is going to be very prescriptive as to what slice of the asset universe they want to hold. I'd like to also tease out, I'll stop here. The active-passive debate, I think, is really, we need to work harder at making this intelligent. to be blunt, there are two ways to make money in asset management: asset allocation and security selection. And in the security selection universe, whether you can buy this security more efficiently than the other guy or whether it's a little mispriced, that's at most 20% of the available return that's out there in the universe. And 80% of the returns you can try to capture are from allocating across sectors or asset types: bonds, equities, different slices, emerging market. And there, the passive revolution of ETFs and Vanguard and all of that is all about giving the people the choice of which sector they want to hold. So that the asset buyer, in that case, you buy this passive fund or that passive fund, you're now making active choices about which sector to hold. And that's actually where most of the returns live, because most of the returns are relative to your own objective and your own liability. There isn't a single one right, true liability, one true right set of objective for investors. It all depends on what their horizon is and what their volatility constraint is. And so I think that the passive revolution we see taking place is giving people, many more investors, sophisticated and unsophisticated ones, the ability to choose that and make their own asset allocation, which is a very active choice. Those are my two interventions.
Anyone else on the... How efficient as an allocator and
Maybe I'll make two different points.
Okay.
Thank you.
Hold it close to your...
That work? Okay.
We're getting a little more amplification now, so I think they've stepped up.
I mean, one thing that I constantly observed looking at things from my work in the government was how beneficial it is in the United States to have the capital markets that we have, because we take a lot of risk off of the banking system. So I think that, you know, in one sense, I see that as a great strength of our financial system. The one point I was going to add, and I agree with the point Peter made about asset allocation and security selection, passive versus active. I don't think I can add to that, but I do think that in the presentation of the asset manager as purely an agent and the client as completely directing activity, that's somewhat disingenuous, I think, if you think about the role that asset managers play in product design and innovation and bringing things to market. So I think we want to be careful in thinking about where does the asset managers, where do you draw the line between what the clients are demanding and what the asset manager is designing? So I would throw that out.
Okay. I was going to come to you a little bit about the risk, but if you have a comment on the first topic, but the other one.
Yeah, just very briefly to add again an emerging market dimension to this. We've seen in many emerging markets that the asset management industry, pensions funds and others, can have a very beneficial effect on helping that capital goes to gets to a more efficient allocation, developing capital markets more generally. So I do think that there are many instances where we can see in less developed capital markets how the growth of asset management has had a positive contribution. Also in terms of stability, we looked at that in our Global Financial Stability Report last April, where we saw that financial systems with the largest share of asset managers were more able to withstand shocks that come from abroad.
If I could just, sorry, yes, you mentioned the academic view, so I thought I would just throw in two points. The first is, I think that to a first order, when we think of asset management and its efficiency, it's really one about lower transaction costs, allowing individual investors to more broadly get access to capital markets at large, and so the efficiency would come through that angle. The second point about active versus passive, I think there has been a little bit of a migration in the academic view of the role of active investing. So I think that the view that passive outperformed active, and why does active exist, is probably maybe 10, 15, 20 years ago. There's this work by Jonathan Burke and Richard Green that's got a lot of play over the last decade or so that sort of views the world in kind of a general equilibrium context, and that the fees that go to active investing and the size of those funds kind of all work in a kind of a general equilibrium context where there is a role for active and passive investing along those lines. So.
Okay,
Now,
quick comment.
my good friend Myers accused me of being disingenuine, and I take that hard. I am really going to push back, and product innovation takes place in a very big dialogue of investment bankers and pension funds and broker-dealers and commercial bankers and mortgage originators, and this is a very complex ecosystem in which the asset manager is one of the players. But to use the asset manager definition, again, narrowly, as if we're just talking about those who call themselves asset managers, or are we using the term to mean those who have their hands on assets? And if you want to use the latter definition, of course they have a big say.
Yeah.
But then we're talking about the pension funds and the insurance companies and everyone who represents a pool of savings. Those are the people who direct the people who are the narrow asset managers. And it's everyone in the conversation. But I don't think I was being disingenuous.
I actually wasn't saying that about you, Peter, so don't take it personally.
Okay, let me turn now to the risk side of this, the stability side of this. And Gaston, I think you were the person that most specifically was concerned about runs on assets. Matthew talked about that, but I think came out on saying it's not. Asset managers are not a risk. But you are concerned particularly in fixed income funds that maybe there are these risks. You also bringing a global perspective from your position at the IMF. So just tell us a bit more about that. I had thought that really the main risk was the one that happened in the crisis, which is that money market mutual funds that had pledged a constant price got into trouble, and the SEC has proposed some rules on that. So tell me, is it fixed income more broadly, or is it just the fixed NAV? And if it's the fixed NAV, have the changes in the rules dealt with the risk issues there, or are there still systemic risks in that industry?
Thank you. Yes, I don't think it's only the fixed NAV. As I try to highlight that there are also incentives, there are also first mover advantages if you don't have fixed NAV or guaranteed returns. And they come from two sources. They come from, first, the notion that if a fund faces large redemptions, that fund is, has some kind of pecking order in selling assets. It will maybe start selling the most liquid assets first to meet initial redemptions, and then gradually move on to sell less liquid assets. And if that's the case, then there is an incentive for the investor to move quickly if he or she observes that others are moving. Okay, so that's number one. Number two is the pricing issue, whether the costs of redemptions, the transaction costs and so forth, that whether they're passed on to the remaining investors of the fund or not. That's also an important issue. There are differences in how that's being done. So these are two sources that create, in principle, a first mover advantage, and that's important to understand in the sense that that makes it different from the situation where investors hold securities directly, so that's the point. Now, as I said before, we need to still understand how important is that, and what consequences that may have, but it can have.
Get mad.
Sorry.
Sorry, I was
And
restraining Peter to my right.
And can have,
Finish your
conceptually it can have very important consequences if the magnitude is large, through these price externalities, through fire sales and induced effects on other parts of the financial system.
Okay, let me ask you, Matt, to comment on that, and then I'll come to Peter.
I mean, I laid out like 4 hurdles I think you have to jump, and so I sort of stand by that. But I think Gaston's making the point that the funds don't price the their portfolio appropriately, meaning that if you're in a liquidity crisis and I want to redeem from that fund, there's a price at which I can get out of those securities. There's kind of a market price and a fundamental price. If they're using the market price, or I think there was commented 60% use the bid, then I don't see the issue. It's irrelevant whether they're selling liquid or liquid stuff. It depends how they're pricing the illiquid stuff on their books. If they're overpricing it, then I agree, you're more likely to run. But if it's priced correctly, meaning it's priced the same as what you'd see in the marketplace, then I don't see the incentive.
I was really echoing Matt's earlier point. Compared
come a little closer?
compared to what? In a world of all principles, there's still a first mover advantage. And if we're going to make the comparison between asset managers as delegees versus banks who hold it on their own balance sheet, I don't think it's very controversial to suggest which one is more likely to have an accurate mark-to-market and which is not.
I was just going to tell one story. I think it was about a year ago, a corporate bond portfolio manager approached me and said, I do not have sufficient liquidity in the street today to meet redemptions in my portfolio. And aren't you worried about that? And I said, I absolutely am worried about that. You know, Wall Street is carrying less inventory for a whole host of reasons, but I think you should be worried about it as well. This is your portfolio. You're offering liquidity on something that you're worried about, and I think we both need to be concerned about this. You need to think about it from a structural standpoint in your portfolio, and we need to make sure that we are paying attention to the market outcomes of changes in regulation. But this is a very dynamic problem, and I think that it's something that is shared by both the asset manager and also by the regulatory community.
Bob Posen, who couldn't be here today, has said, if I'm repeating him accurately, I hope I am, that shouldn't be a worry. If it really came to this liquidity issue, you would allocate the assets on a pro rata basis to the clients of the fund. So he didn't see that was a liquidity problem. If you had to redeem, it would just be on a pro rata basis. You would get a share of the individual assets.
I never met any clients who wanted to get their liquidity in terms of actual shares of the securities. They usually wanted cash. So I agree that is a good strategy and a fair strategy, but I think it's probably a deeply unpopular strategy in terms of meeting client demands.
Okay, well, I'm probably not accurately reflecting the full story of what he had in mind, but let's make a comment, and I'd like to then throw the questions open to the audience. So please think up some questions.
No, I just wanted to say that, yes, there is also a first mover advantage in the aggregate if investors hold securities directly, but it is accentuated if you have collective investment vehicles that have these features that I just described. And you know, the accurate pricing of illiquid assets at any moment in time, there's also a dynamic effect, right? If you start selling, you know, there's an impact on markets. So it's I think I still disagree with your assessment there.
Some questions from the audience. There's okay, let's start here. Please wait for the mic. Please identify yourself and a short question, please.
Yeah, my name's Li Yang. Thanks for your presentation. Okay, my name is Li Yang. Thanks for your presentation. I think this should be a very important subject. I just want to bring a parallel line. Recently, we have all those financial crises, and this will be part of the sector of the financial business. So I think, do you have any study or you can address the issues about the financial loss or investment loss for individuals or business? Well, that's the individual business, that's the money come from for economic growth. If you are talking about financial stability or economic growth, this is really the issues. So could you address the issues of financial loss or financial crisis on this topic? how much money the individual lost, they didn't get the money, or the asset manager or the company didn't give the money back to the individual. They lost all the pensions, benefits, and things like that.
Okay, I think you're asking a much broader question than we're covering here. I don't know if any of the panelists want to tackle it. Clearly, there were a lot of financial losses in the crisis. We're looking at policy and behavior around the asset management industry. So I think that may be the best I can do if one of the panelists wants to go further. Okay, another question. You pick one, I don't know.
Sarah's in charge.
Hi, John Topoleski from the Congressional Research Service. And my question is sort of, presumably, both investors and the sort of the users of capital are best served when if the asset management industry is competitive. So how competitive an industry is it? I don't, in sort of like that sort of classic economic sense.
Okay, question. How competitive is this industry? Do you want to answer that, man?
I think parts of the industry are highly competitive. I think performance is measured daily. It's very transparent. There's a lot of ability to understand differences in asset manager performance. I think other parts of the industry, again, the less public parts, are far harder to measure and far harder to appreciate the differences in performance. So I'd say it's an uneven landscape, would be my response.
So I'll ask Peter's question, competitive compared to what? And I think there are a lot of asset managers, right? But do you see that as being competitive, or do you think there are certain, tacit agreements around fees and things like that?
I think the number of actors, it's a very competitive. Based on market share and number of actors, this is as competitive a sector as there is in financial services. I think that inertia and habit are in all sectors of the market, and those create problems on pricing. But that's true across the industry as well. And I think that in competing for assets, if you turn your efficiency competitive around in terms of competing for assets rather than clients, it's highly competitive. I mean, it's as competitive as anything I can imagine on the planet. But the competitiveness for investors is lots of choice and some inertia in pricing is my simple answer.
Well, I think if I'm correct in saying that David Swenson's book, he was is the asset manager at Yale, and I think in his book, if I'm remembering correctly, he sort of said, well, if you have a lot of money, you have access to certain kind of investments that the small investor doesn't have, and you're able to make much higher returns. Is that a problem of competition, or is that just part of life, so to speak?
Well, it's hard to make good returns. That's hard work. I think the asset management industry and financial services in general is a little like New York City. My friend Steve Giacchetti at Brandeis likes to say New York City is the only place on the planet you can pay whatever you want for something. You want to pay a lot for it, you can pay a lot for it. You want to pay a little for it, you can pay a little for it. If you want to go looking around the asset management industry, I think you can find price competition. And if you don't go looking for it, you won't find it.
I usually hold on to my wallet when I go to New York City, but okay. Can you bring the mic up? Are you? Yeah. Please identify yourself and.
John Nelson with Wall Street Without Walls. Looking at the growth issue, if you were to have something in the impact investment space with a guarantee or some other kind of credit enhancement, what would be the effect, in your view, on asset managers to make what might be perceived as a risky investment in a growth area, economic development, for example?
Do you want to take that? The impact of the guarantee?
Can I clarify? Are you thinking the asset manager makes a guaranteed return?
No, if you're looking at mitigating risk.
struggling on that question. Good question, but not one we've been able to answer. There's a question up here.
Nancy Jacqueline, Johns Hopkins SICE. I have two quick ones, just topics that are related to what was discussed. One on stability. Obviously, the message of this panel is the issue of liquidity, essentially, in fixed income markets. And is there anything that can be done in terms of public policy or otherwise to help stimulate industry developments for there to be more platforms for direct trading of fixed income instruments so that there is more liquidity in the market? The second question relates to the question of economic growth and whether anyone has a view on the role of index funds and benchmarks that are essentially indices that shifts investments into what's in the index as opposed to what may be the right investments in terms of what the economy needs or wants in terms of resources. In other words, are resources being allocated efficiently when investments are going into indexes? And certainly we've seen those kinds of issues. I used to be U.S. director at the IMF, and what was going into emerging markets. Argentina wasn't doing well. They were in an index. They got a lot of money. So.
Okay, good question. Goes back to what I think we discussed earlier. So there's a lot of money going into index funds. Are somehow other productive growth-enhancing investments being shortchanged because of that? Anybody want to comment on that?
Nancy, I think that to take your second question first, my point about the ETF and passive revolution, it's moving on to so many choices now that the providers of these products are trying to create very intriguing slices of the world that they think will grow. And I think it is not so much the case anymore. While there are indexes that are big and diverse, the growth area of the industry has been the small targeted indexes that are trying to get at certain growth opportunities or income opportunities or whatever it is. So there's a whole lot of choice out there, and I think we have less of the problem you're describing from years ago than more of it today. Now, maybe we've got too many such funds rather than too few. But so I don't think we have that kind of growth problem you're referring to. The second question.
Well, let me give a quick
less
answer.
of it today than 20 years ago.
I think those kind of investments normally we have thought of as coming either from bank lending to small and medium-sized enterprises to venture capital to angel investors. I think that segment of the economy, there's some signs that it's weaker and it has not recovered in the way that other parts of the economy have, whether it's because of lack of access to capital or for other reasons is debated, but I think lack of capital in that segment. But I'm not sure the asset management industry is the one that's going to fix that. I mean, you really need to have a personal involvement, at least of a bank or of a venture capital person in that part of the economy, if I'm understanding you correctly. Mm-hmm. Okay, another question. Over
here. Morning. Thank you for your presentations. Con Hurley, Boston University. I guess a question to Ms. Miller and then to the panel as well. You opened up the topic of lender of last resort for this industry, which I find particularly frightening. And I wonder if you might elaborate on that. But I would ask the rest of the panel, with the lender of last resort benefit goes a subsidy. And I wonder if the rest of the panel has any indication that the industry as it exists now is receiving any subsidy in the form of the assumption that the government will bail it out.
Yeah. Mm-hmm. Yeah, I raised that in a rather provocative way, and if you recall, I said, I don't know the answer to this, but it would be better to have that debate today than to have it in a moment of a storm or a crisis. And I think the thing that I observed during the financial crisis when I was managing fixed income assets was there were parts of the market that were tremendously liquidity impaired, but not credit impaired. There were parts of the market that were insolvent and credit impaired, and they were going to fail. And so the question is, do we want to have any public policy plan for liquidity in a liquidity impaired environment? Would that send the wrong signals to asset managers and create poor incentives? These are the tough questions that I think need to be thought about. As you probably understand, Dodd-Frank has taken away that ability. There is no ability to rescue a single institution or fund or something like that. There are some authorities to provide broadly available support to solvent institutions. But I think in this context, we can keep talking about liquidity, and we can try to think about ways to provide more of it to the market. What is the market going to respond in terms of providing more liquidity? I was going to make a point in answer to Nancy that, to me, it would be very interesting to think about, from the context of performance measurement of fixed income managers, could you measure them on their investment performance outside of their cash or liquidity? Would that, there are multiple problems with that, but it seems to me you would at least take away one of the reasons why many managers don't carry much liquidity. But I was simply raising it as something that is kicking around in the discussion, that I think it would be healthier to bring it out and talk about it and resolve that. Should there be any liquidity support in stress markets or no? And if it were built, what incentives would it bring, or what should we be concerned about there from a financial stability standpoint?
Other panelists? Yes?
I mean, I think in the current system, I don't think there's a role for a lender of last resort. So I'm with you a little bit on this. But if, for example, future regulation was going to impose, like Gates...
You're actually a little bit too close.
Oh, okay. Sorry about that. If financial regulation was going to impose, like, Gates at the fund level, where investors could no longer access their liquidity, their capital, then for a fee, maybe the government could provide, some haircut and provide, some liquidity there. But I think that would only be in the context of, where you close the system down.
Okay, we've reached the end of our time. I really think it's been a wonderful panel. I appreciate everybody on it. We have a 15-minute break now. Please get some coffee or whatever and come back in 15 minutes. Thanks to the audience also for some great questions.